let's drag in David Malpass here, who asks questions of the chairman once every 2 years or so at the Economic Club of New York. Good to have you here.
Hello,
what would
Tom.
you ask of Chairman Bernanke today?
Well, I'd like to know whether he thinks quantitative easing is something that's become a permanent policy for encouraging growth. My view is it hasn't really worked to encourage growth at all. So it'd be good if the chairman said it's not in our toolkit. We used it once, and the Fed shouldn't be using it anymore.
There is a difference of opinion. Drew Mattis just on agreeing with you. Unlikely we'll see QE3. James Shug of Westpac yesterday suggested we could even see disinflation or a bout of deflation later in the year, and with a sticky unemployment rate. What does a politician do? You worked with the first Bush, that's a mouthful, the first Bush administration. Politicians have pressures, don't they?
They do, and I think Bernanke addressed that at that recent speech where he said that there's limits to what the Fed can do. Monetary policy really isn't the tool that can get us out of our current
What is the tool?
You got to have regulatory reform that gives some certainty both for banks, but it's all across the board. Washington is just in an all-out boom. This is a gold rush going on in Washington right now to regulate the whole economy. And so they've got to stop that and let businesses earn profit and deploy their assets where they want, that whole thing.
Bring up this chart right here, long-term view. I made this chart today, blew me away. Corporate profits pre-tax adjusted for inflation. Now, there's a little hump there, the late 70s, and there's a little hump the 90s. David, it's a gilded age, according to Jim Grant.
It is, but where is a huge amount of that profit is being made abroad.
And kept abroad.
And kept abroad, because we have tax obstacles to bringing the profits back into the U.S. So with some regulatory reform, of course, as you know, I want us to have a strong and stable dollar instead of a weak and unstable dollar the way we do now. Because where do those profits go? It's showing up in your graph. It's big banks and currency traders making huge amounts of money off the economy by swapping idle pieces of paper. That's harmful, and that could be corrected by the president any day he wanted to. George Bush could have done it, and I argued strongly that the Bush 43 administration should have adopted a strong and stable dollar to keep capital back in the U.S.
What is the industrial policy to raise the investment? Bernanke, Rogoff, Meltzer, Krugman, an eclectic group of our best academics. It's a mystery to how to get investment going. Did we just transfer that investment growth abroad?
Yeah, as long as you have a weak currency policy, then investors have to take their money out of that country. Have to. Whether it's Mexico, whether it's any country. Great Britain in the 1960s and 70s, the whole game was to borrow pounds and take it out of the country, and that's what's happening to the U.S. We're decapitalizing ourselves by the weak dollar policy, and so that explains why does GE want to build factories abroad? It's because they can borrow dollars and make money on the foreign exchange.
0.3623%, two-year yield. I got $100. I think I get 36 cents. Yeah. It's a joke. Yeah. Is Ben Bernanke running this Fed meeting today in his press conference? Is he running it for James Dimon, or is he running it for, I'm going to make this up, Gerald Dimon in Peoria, Illinois?
Clearly, they're running a policy, not just Bernanke, but Washington is running a policy that works for big government and for big corporations and big banks. And that's harmful to the man in the street. And it could be changed. And I don't think there's ill will but a near zero interest rate policy when we're in a full recovery doesn't make any sense at all. We needed to end that zero interest rate policy a year and a half ago, and they won't do it today.
Why not? Why won't they? I mean, McKinnon at Stanford talks about this. If they announced a path of 25, 25, 25 up to 1 or to 1.25, would the world end? No, and Greenspan finally did that in 2004, and it was a better world. Remember, they'd kept the 1% rate policy for way too long, and they finally broke it. And the people in the bond market said, "Oh, it'll be the end of the world." When they did it, it didn't hurt anything. Chart, Reagan, Malpass, here it is. Reagan was not timid. This is the criticism from Krugman and Meltzer of this president. There's a surplus, the Clintonian surplus. I'm just trying to get David going here. And then down we go, -4%, and we fall off the cliff. Are we off that cliff because of two wars? as the president speaks tonight?
No, I think we're off the cliff because Washington is spending way too much in addition to two wars. We're blowing money on badly managed policies. The administration has no real incentive or accountability for overspending. They don't care. And so that's what happens when you don't care.
We mentioned this with Alan Meltzer. We thank you to have both of you on the show today after 4 years of his crisis is really something. Paul Krugman out with a terrific lengthy essay off a speech in Cambridge, Mr. Keynes and the Moderns, and he essentially says, look, we can do more government programs. We can be more assertive in our public policy because rates have stayed low. I know you don't agree. What is the key Malpass-Krugman distinction?
So somehow the Keynesians don't recognize that when the private sector sees the government overspending, they cut down on their own spending. That's only rational, and yet that's not accepted in their theory. They think that they can borrow money, and if rates are low, then everybody will just go about their business. That's not what happens. The private sector takes their money to another country where that's not the behavior done by their governments.
Do you see any indication in the nascent 2012 debate of a new dialogue, Republican or Democrat?
So far, it's been harmful. You know, it's all centered around the Democrats saying we want more tax. You know, it's this artificial concept that there's got to be a trade-off between tax increases and spending cuts. That's artificial. We have a government that's completely out of control on the spending side, and they need to focus on it.
Europe. Okay, we had a big vote. Spreads continue to widen out. How does the European peripheral debacle redound on America?
I don't think it changes our growth outlook or the world growth outlook. There's a huge problem in Europe of sharing the losses. Too much money was lent to Greece, to Portugal, to Ireland, and now somebody has to pay that loss. And it's German taxpayers, it's the local people in Greece, it's the IMF that's going to put in money, and the European Union as a whole, and the banks. Some bank losses will be absorbed, and what they're negotiating is how to divide up all that loss.
Are they negotiating?
In a way, it's a negotiation, yes. It can. Remember how the Latin debt crisis was done?
Plan, yeah.
Well, but it took 7 years of people meeting, of smaller rollovers, of kicking the can down the road. I don't propose that for this, but they're doing the same kind of a program of delay, and then trying to figure out when the deal can come together to actually do the restructuring.
Carl Weinberg's he's been way out in front of this on looking for a constructive restructuring. Earlier this morning on Bloomberg Surveillance, I spoke with Dr. Weinberg of High Frequency Economics, and I asked him about the threat of U.S. exposure to European banks' money market funds.
Well, we just don't know, Tom, because of the credit default swaps and all the other off-balance sheet contingent liabilities. We have no record of who owns them, of who wrote them. So if they get triggered, we could very well see the shock in the sovereign debt market here be translated into our markets through these instruments. And, of course, we have no documentation on it. So it's something to worry about.
And there's Carl Weinberg, and the money market, 40% some of our money market funds are over there. LIBOR begins to, little shifts in the wind. I don't want to be inflammatory. Is the financial system healing, or are we just moving the proverbial can from this road to that road to the other road?
Remember what happened after the Lehman bankruptcy? People hadn't realized that Lehman was issuing commercial paper and that it was being recorded at net asset value of 1.
We should say also that you lived through this at Bear Stearns. Some of our viewers don't know that, so continue.
Bear had already disappeared by that time, but no adjustments had been made in the system. So as Lehman filed bankruptcy, then that commercial paper became a big problem. Now, a difference here is that Greece won't be filing bankruptcy, and so their commercial, the banks that are involved, right now we don't think a bank is going to declare bankruptcy. You know, Lehman was somewhat unique. I don't think it translates to the Greek problem in that legal filing that disrupted the commercial paper markets worldwide. So I took Weinberg's other point on CDS more firmly. Remember, in the Lehman case, AIG had written a lot of CDS exposure. We don't think in this crisis that the U.S. has written a lot of that CDS exposure. So probably we don't have that big a ripple effect to the U.S.
This has been wonderful. David Malpass, thank you so much.